And then there is General Electric, and really cash flow continues to be in focus. That's really the thing that investors watch for General Electric. Industrial cash flow came in ahead of estimates, and the company is predicting industrial free cash flow of $2.5 billion to $4.5 billion this year. So seems to be what's fueling the increase in the shares. John Eade is joining us now to discuss this in more detail. He's Argus Research Senior Analyst. John, thank you for being here. So what is GE doing right now that it wasn't before? And this forecast this year does make it seem like there's some sustainability here.
So thank you for having me on. GE has been working on this turnaround now for the past 2.5 years with the new CEO, Lawrence Culp. He inherited a train wreck of a company that was losing a lot of money, wasn't getting any new orders, couldn't generate any cash, and it has taken him some time to start to show results. But of course, a pandemic and a recession hit in the middle of that turnaround. So now we're 3 quarters into the pandemic. The company cut a lot of costs in the second half of the year, more than $3 billion in cash saving steps, and it is starting to see orders pick up, right? So those green shoots coming. And as you mentioned, it generated positive free cash flow for the year, 1 year ahead of schedule. Generated profits in the fourth quarter, is profitable for the year. So there's some real signs of progress. Still a lot to be done, but good news for GE this morning.
John, I'm not even on the earnings report yet. Let's take a step back here. Should investors, the average investor, they're now seeing GE, it's our most top traffic ticker right now on Yahoo Finance. Should they avoid a GE simply because it's hard to understand their financial results?
Well, that has been the case for a long time. And I will say that GE was never as complicated as the old AIG. But one thing that the CEO Culp has done is he's simplified the businesses. He's gotten rid of the locomotive business. He's sold off oil and gas. He sold off part of the healthcare business and used that cash to pay down debt. Now the company has 4 main growth engines. They've got aerospace, which is a mess right now because of the decline in air traffic and exposure to the MAX 37 jet. They've got healthcare, which is stamping out a lot of ventilators and is doing very well. They've got renewable energy, which is a real Biden idea. Strong order growth in this fourth quarter for wind turbines and offshore turbines, still not profitable. So some wood to chop at renewable energy. And then they've got power, which has been the longtime problem child, but turned profitable in this fourth quarter and is generating revenue growth. So I think the company's a little bit more transparent and the picture's a little bit clearer going forward.
John, you referenced some of the divestitures that Larry Culp has made. Do you and you outlined now there's kind of 4 clear groups. Do you expect, though, that maybe more streamlining of this core business is possible in the years ahead?
It certainly is possible. And remember, they almost cut off the entire healthcare group, and that's been a real crown jewel. I think Larry Culp looked at other areas to save money and was able to keep on healthcare, and that's been a consistent performer during the pandemic and during the recession. The power business has been the challenge, and they've restructured the power business into like a legacy old group and into a new future group. So I wouldn't be surprised if somewhere down the road they spin off or divest that legacy old power group and focus on what's going to sell in the future.
John, the proposals out of the Biden administration, are they a tailwind or a headwind to General Electric?
Well, it's a bit of a mix, right? The focus on clean energy and green energy is very good for General Electric because that's about 25% of their sales, and it's a growing part of their orders and likely their full business. However, higher taxes are probably not a good thing for General Electric. And the aggressive fiscal spending could raise interest rates. And while GE has paid off a lot of debt over the past couple of years, it is still pretty heavily indebted and would prefer to have rates low. So a bit of a mixed bag for Biden and GE.
All right, John Eade, Argus Research Senior Analyst. Always good to speak with you. Stay safe. We'll talk to you soon.
Thank you. Have a good day.